Good morning, ladies and gentlemen. To those that are a little bit further east of us, good afternoon, and thank you for allowing your lunch to take place over our seminar. And those later in the day towards China and Hong Kong, good afternoon, good evening, wherever you are. Pleasure to have you all attending this pre-budget tax planning webinar for UK residents and UK nationals living abroad. So applicability, UK residents, total applicability to UK nationals living abroad, to those even that are not UK nationals, not UK resident or domiciled, but making economic investments in the UK. Those a little bit on the fence, non-doms that are thinking, that are UK residents thinking of leaving, and British taxpayers of a non-domicility and UK domicile thinking of leaving. Quite a wide applicability for this 1 hour webinar. The webinar, ladies and gentlemen, is being recorded. So you'll have a recording link sent to you along with this presentation, a lot to get through. Presenting this morning is Lawrence Lancaster, an English barrister at law, Group Head of Tax of Sovereign, and I am Managing Director of Sovereign in the UK in London. My name's Simon Denton. So there's the title, there's the theme, the presentation. We're going to welcome, we've got 600 people registered to this webinar. Many are dialing in as I speak and as Lawrence speaks, so we'll just get going on the formalities. It is being recorded. The presentation will be sent to you. We'll take questions as we go, but there's a questions and answer session towards the end, so there are perhaps snappier questions, especially on each topic. Next slide, Miguel, please. On each topic. Any of those topics you'd rather ask a question because it's highly related to Part 1, tax reforms and October budget the 30th of October. Part 2, pre-budget planning. That's off the fence in terms of what we believe is best to do, pre-budget planning for non-residents. Then Part 3 is pre-budget planning for UK residents, but that's both domiciled and non-domiciled. We're also going to cover persons and companies that are not British resident, that have an economic interest in the country, where the country is going at the moment, although the budget is coming in on the 30th of October, and that's the next milestone after this webinar. And then Part 4 of the content of today's webinar is, Miguel, just go back a little bit, please, is leaving the UK. A lot of people have left, as 5 million British persons living abroad, and there's scheduled to be quite a bit more new residence options. So that's the contents of the webinar. Do ask questions. It is being recorded. Thank you to each of the 600 that have registered to attend. There's lots of people coming in. We'll make a slow start. We've got to get through 4 chapters, 4 parts of the conference. And I'll turn to my colleague, Lawrence Lancaster.
Thank you very much.
Has actually got a bright blue sky behind him in Dubai at the moment. Yeah. He's just arrived there.
Potential for everyone to consider these options, and Simon is going to be taking us through
Next slide, Miguel.
Other residence options in Part 4. So just to explain the rationale for what we're doing today, everyone, and good afternoon, where it's lunchtime here in Dubai. What we're kind of doing today is we've got the budget is on the 30th of October, and we wanted today's focus to be mainly on preemptive planning. So there's been a lot of speculation in the media as to what they could introduce. And I think it's almost certain that we're going to see capital gains tax rates increase and inheritance tax reliefs, certain key reliefs abolished. So that's almost guaranteed to come in. So the idea for today is to look at what we've got our crystal ball out a little bit, and we're going to be gazing into it and making some predictions. but I think that there are some predictions that are very likely to come in. It's just a question of when. So what we wanted to then do is to just to go through some preemptive planning that you can consider. So that's what I'm going to focus on at a high level to start with, and then we're going to go into some real life case studies, or are inspired by real life cases, I should say. And Simon's going to deal with the first one of those. Are you hearing me okay there, Simon?
Yes, very good, Lawrence.
Yeah, all
Very good,
fine,
thank you.
great. Okay, so this stuff, the background to this is probably many of you are aware, the abolition of the remittance basis, and that's one key aspect of these reforms, and the overhaul of the inheritance tax regime. This was announced by the Conservative government, the former Conservative government, on budget day this year. So that was 9th of March, the first budget that we had of this year. And they poached or stole Labour's policy, one of their flagship policies, one of the few that they had, which was the abolition of the remittance basis. And what they did at the same time, the Conservatives, was to say that we're going to get rid of domicile as well, as the key criterion for determination of the charge to inheritance tax on worldwide assets, and we're instead going to use a residence-based test. So as we speak today, 23rd of September, 6 months later, we haven't had any legislation yet on any of this. We've had the Conservatives' policy statement that was I'm alluding to at the moment, and then we had Labour's policy statement that they published at the end of July of this year, which was essentially in line with what the Conservatives were saying, but there's some subtle differences. So to rattle through this, Labour has confirmed that it's going to abolish the remittance basis, and it's going to be replaced, I should say, by a 4-year regime. Now, we've just had a question come through, Simon, I've seen popped up as to what the remittance basis is. What I'll do is I'll read through these and then I'll explain that and contrast it with the new FIG regime. So remittance basis is on the way out, FIG is on the way in. The new regime will be effective from the 6th of April 2025. Transitional release and the full details, we hope, will be laid down in the budget on the 30th of October. That's why we're not going into too much detail today on it, because there's no legislation at the moment. 100%. So under the new FIG regime, and what does that stand for? Foreign income and gains. So they came up with this new acronym FIG. We hadn't seen it in the tax world before, but it's a new one for us all. I suppose at least it's easy to remember. It's one thing going for it. So 100% relief on these foreign income and gains for the first 4 years of tax residence. You can even bring in your FIG and not taxed in the UK, even if it's remitted. And you get this treatment for 4 tax years, as I've said, but you only qualify if you've been non-resident for the 10 previous consecutive tax years. And we think that the test is going to be applied on the 6th of April 2025. So to come within this FIG, you've got to have been non-resident for 10 or more tax years prior to that being introduced. But you may find that people who are UK resident at the moment and have been resident for, say, 2 years on 6th of April 2025 and previously had done more than 10 or more years away, they may still qualify for, say, 2 more years in that example. As I say, I'm not going to dwell on these intricacies today. One disappointing thing about Labour's policy announcement was that excluded property trusts, they're saying, will lose their grandfathering for not just for income tax and capital gains tax, but for inheritance tax as well. And that's a clear difference between the Conservative government's proposal and Labour's. The Conservatives were saying that you would be taxed on, the settler would be taxed on income and gains of EPTs, but their exemption from inheritance tax would remain. It appears that what Labour is saying is that even for pre-existing EPTs, you'll lose the IHT exemption after 10 years. What we're saying is that you're still likely to be better off in an EPT than outside, even what Labour is saying at the moment, if you're currently non-dom, because there are more options that you can do if you're in a trust. For example, exclusion of the settler is a classic way of ensuring that the inheritance tax, that the trust remains outside of inheritance tax, although it is subject to those charges every 10 years. The final point is this point on inheritance tax. It's going to be, domicile is out of the window, and it's going to be replaced by a residence-based test. We really don't know what that test is going to be. We really don't know how harsh it's going to be for expats who are currently still UK dom, have been non-resident for 10 tax years, or are approaching that tax year, or will become non-resident on the 6th of April 2025, will have done the 10 years. What's their position? We suspect it's not going to be as rosy as what people think. Labour are conducting the consultation in private at the moment with inheritance tax. So again, let's not speculate further on this. And let's perhaps now move to the questions on this.
Lawrence,
on this slide.
let's just take a quick one. EPT, Susan, thank you. Excluded property trust, an offshore trust settled by a non-domiciled or a non-UK domiciled, appointing an overseas trustee, and assets going into trust that are non-UK situated. That's the criteria of an excluded property trust, an offshore, usually an offshore family trust. Peter Lawrence, let's do the quick one, as we'll speed up as we go along. I think he said, Peter, is there any capital on foreign on FIGs? I think it applies to income and capital gains, doesn't it?
Yeah, that's right. So it applies to foreign income and foreign gains that accrue while you are UK resident for the first 4 tax years. Any income and gains that accrued while you were non-resident, that's clean capital still. But any that accrue in the first 4 years is tax exempt, and as I say, can be brought into the UK
income and
tax
gains.
free. But it's like a sledgehammer effect. After the 4 years, you're then taxed on everything. So we're going to.
And Lawrence, just quickly on the remittance basis, that's the non-UK domicile that have lived in the UK for 7 and 12 years. Just quickly on that, please.
So to be very quick, the remittance based is a simple system. It just means that your foreign income and gains are not taxable unless they're remitted, i.e. brought into the UK. It's a regime that can only be accessed by persons who are non-UK domiciled under general law, and who are not deemed domiciled for tax purposes. They become deemed domiciled after 15 tax years. So it's available essentially for 15 tax years. You have to pay for the privilege after 7 tax years, £30,000 a year from tax year 8 to 12. £60,000 a year from 12 to 15, from 13, 14, 15, and then it ends. So that's it in a nutshell. So I think we can then move on.
But actually, effective in April next year, this is all going to be abolished, isn't it, Lawrence?
Yeah, so the remittance basis gets out of the window and replaced by the foreign income and gains exemption.
Okay, we've got next slide, Lawrence. We've had a lot of questions so far. Thank you.
So we'll race through this. So the budget's going to be held on the 30th of October.
Next slide, Miguel, please.
We're on the correct slide.
Sorry, beg your pardon.
This is correct. So at the moment, the rates of capital gains tax are historically low. We have rates that apply to non-residential property, 10 and 20%. The residential property rates are 18% and 24%. Most anyone who's subject to the 40% income tax rate is subject to those higher tax rates. So most of you joining us today, if you realise a capital gain, it's non-residential property, 20% rate. If it's resi property, it's 24%. The removal. So what are we going to see on the 30th? I think we're definitely going to see those rates go up. The speculation that they could go up to be equal to the 45% income tax rate. I think if you're going to see that, then they'll have to reintroduce some relief for indexation, which is to account for the fact that the original acquisition cost of an asset is not increased to account for inflation. That was removed by Gordon Brown previous Labour government. But I think that's something, if they're going to clobber you with such high rates, they're going to have to then bring back that relief in. So we'll have to see. But certainly the rates at the moment are historically low, and we'll come on to what you can do to take advantage of those rates now. Looks like they could remove the capital gains tax rebasing on death. At the moment, when you die, all your assets get rebased to their market value on the date of death. So when your estate comes to administer the assets, make transfers, there's normally no capital gains tax, and you still get that rebasing even if your estate falls within the nil rate band, even if you leave it to your spouse, so it's spousal exempt, even if it qualifies for BPR. So in all cases, you may not actually be paying any inheritance tax. You still get your uplift for capital gains tax, and then that potentially provides planning for lifetime transfers after that. That's something they're definitely looking at and could go. Another big one is this potential exit charge for individuals. So at the moment, for UK trusts, if you move a UK trust offshore by appointing offshore trustees, so say you've got a UK trust and you appoint trustees in our Isle of Man office, to give you an example, there's an exit charge. The trustee is deemed to dispose of all of its assets, and it's exposed to capital gains tax for the privilege of moving offshore. Same applies to UK companies. At the moment, individuals can become non-resident without any exit tax. They don't get taxed when they become non-resident. I think that could well be introduced, this exit charge, so people are basically suffering capital gains tax when they leave on deemed disposals. So they basically could lock you into the UK going forward. Other areas that are exposed to attack is inheritance tax, and the remove business property relief, and even potentially exempt transfers. These are gifts between individuals under threat. What else? The abolition of the inheritance tax exemption that from which pension schemes benefit at the moment. That's UK schemes, UK registered pension schemes, and of course those schemes that we all know well, QNUPs and QROPs. Also looking to reduce the tax-free lump sum. At the moment, your tax-free lump sum, the maximum that you can take out is 25% of the fund, or 268,000, whichever is the lower figure. Look at the speculation that could go down to 100,000. So at the moment, if you've got £1 million in your pension, you could take 250,000 as a tax-free lump sum. Could be from budget day or from April next year, that's going to go down to 100,000. So that would be massive. Stamp duty, land tax for the poor non-residents, expats, and also non-expats, anyone investing in UK residential property, going to see the surcharge increase from 2% to 3%. That's almost guaranteed to come in because it's in the Labour manifesto. So if we just move on then quickly, I think we've had some more questions.
A quick one, Lawrence, if I may. Peter, thanks for your comment about it may be easier to manage questions in Q&A. I don't know if you're switched on now, but we're getting a lot of questions in chat. But there is a person that's just Mr. or Mrs. R. When will SDL surcharge likely increase? You might have answered that sort of, Lawrence. Will it matter if the purchase was already in the process, exchange come completion?
We're going to come on to that in the planning techniques.
Okay,
here now.
good.
Yeah. Sorry,
and I've got a note from Stephen to say he's here. Thank you, Stephen. Welcome to the webinar. And we've still got people coming in. So we're on to the next slide, please. Thank you for your questions.
So we are there at the moment on the correct slide. So we've got this capital gains tax likely increase. It could well be effective from budget day, the increase in the tax rates. So what to do? If you sell in to a third party, exchange the contracts if you can before the 30th. For capital gains tax purposes, the disposal date is when the contract is concluded, not when the asset is transferred. So that provides you with scope for some planning there. So get your contracts signed if they're not already signed. If you've got assets that are exposed to UK capital gains tax. So for all you UK residents who are with us today, that's everything, pretty much wherever it's located in the world. For non-residents, that's essentially property in the UK. Is your main exposure. If you're not selling your assets that are exposed to capital gains tax in the UK and are pregnant with gains at the moment, so they're worth more at the moment than what you paid for them, then what to do? Well, you want to consider some rebasing. The idea is that you just pay. You rebase, and even though you're not selling the assets, so you're not going to get cash in hand to pay the tax. You are taking advantage of the rates at the moment. So you're going to have cash to pay the tax charge with, and you're going to want to know what the charge is before you do the rebasing, so you're not going to get a nasty surprise. The idea, though, is that you crystallize the gain now, and the recipient acquires the asset at its current market value. And some techniques there: you can either gift your asset to children, that works, or to a structure. And we're going to look at in the Helen example later on as to how you can use structures for that purpose. In terms of how you avoid the exit charge, well, quite difficult, really. What I would say on this, though, is they're unlikely to bring it in halfway through the tax year. So if they are going to introduce an exit charge, I would be very surprised if it's introduced before 6th of April 2025. I'm advising clients on this at the moment, and what we're saying is get out and qualify for split year treatment now, and then you're very much not likely to be exposed to that exit charge. It can't be guaranteed, but you're obviously much better off to do that. And we're going to just look at that quickly later as to what techniques you can use to qualify for split year treatment. So that deals with that point. In terms of the potential abolition for BPR, we're also going to be focusing on this. Simon is in the Clive case study. Get the assets into trust. The simple solution. If it's typically shares in companies, in unlisted companies that are trading, that qualify, you can transfer those into trust. And so you need to watch capital gains tax if you're a UK resident, but there is potential relief there too. So crystallize the relief now before they take it away. Lifetime gifting, pets under threat. Now, we're not talking here, for anyone who's been following the US election, about animals or anything here. We're very much talking about the tax pets, which are effectively transfers between individuals. They're not animals. And the person who is threatening these pets is Rachel Reeves. She's and Labour generally. They are certainly going to be attacking inheritance tax. And one of the cornerstones of planning, probably the cornerstone of IHT planning, is petting. So if that goes, that would be huge. We hope not, but again, do some planning if you're in a position to now, while the law currently stands. Get your lifetime gifting done now if you can. Just watch capital gains tax if you're a UK resident and the asset is pregnant with gains. And again, on the pensions, well, take your tax-free lump sum now if you can. So minimum retirement age in the UK is 55. If you've got a UK pension, take that now. Also, if you've got a QROPS, they're exposed to these changes. Look to take that now if you've reached age 55. Subject, obviously, to taking tax advice in your country of residence if you're non-resident.
Lawrence, when you say now, do you mean before the 30th of October or before the 5th of April? Question from Paul.
It's hard to predict, but I think with these type of reliefs, it's difficult. But certainly on the capital gains tax side, they're going to see that if the isn't effective from budget day, it allows you to do the planning before the 6th of April. So they know that if the measure in relation to the lump sums aren't effective from the 30th of October, everyone's going to be taking their lump sum who's eligible between October and April. So it's kind of going to lose its potency unless it's effective from the 30th of October. So I think there's definitely a risk that it is going to be effective. And please note, everyone who is non-resident who's joining us today has a UK pension such as a SIP. That income is taxable in the UK unless you qualify for double tax agreement relief. So you are reliant on this exemption if you're non-residents. A lot of what we're talking about today has applicability to non-residents, and obviously that's fits with the theme that we've been looking at today. So unless there's any questions,
quick one, Lawrence. I'd like this one because the Steve is a UK national, non-resident for 25 years. Technically, he says still domiciled. I'd question that if you can get your domicile tested.
Well, we'll assume that that's the case for now.
That's the case, but you could look at getting an opinion to confirm your deemed domiciled status has moved to Romania, possibly. His wife is the good Romanian lady, national, domiciled and resident of the good country. Sounds like my IFA, whose wife's Romanian. And if I pass my estate to my wife before I die, is that an acceptable plan of action?
Yeah. So the way it works is if you're UK domiciled and if spouse A is UK dom and spouse B is non-dom, then the spousal exemption is limited to 325,000. If it goes the other way around, so a non-dom to a UK dom on death, you get the full exemption. Now, where it's going, so I think in this case that you would be limited if on the basis that the person who's asked the question is UK domiciled, and on the assumption, that his spouse is non-dom and not deemed dom, then you would be limited to the 325,000. Now, there's a big exemption for this. You can actually you can make an election, the non-dom to be treated as UK domiciled. How the status of this election is going to be affected when domicile goes, we don't know. What it's going to be replaced by, we don't know. But as the law stands, that is currently the position. I'd agree, Simon, with you that the best approach here would be for us to send out the questionnaire on domicile, and we can have a quick look to just see whether the gentleman's domicile whether he has acquired a foreign dom of choice. If that's not possible, then it would be looking at alternative planning options.
So, Steve, if you could send us an email later about, just send us an email regarding that question, and we'll deal with that separately and without initial obligation. Right, we must move on, Lawrence.
So it's on case study now. And I think we've been getting more questions, but we could perhaps take them at the end so we can.
Yes, we've got a questions and answer session. And sorry, Peter, you're not getting the questions through Q&A. You may have to use the chat. Something's not. Don't shoot the messenger there. So case study. We're on to part 2 now. Case study 1. There's the first of 2 case studies. Business property relief, trust planning and active business. And Clive is 60. There's a lot of these. There's a lot of Clives. There's a lot of Clive female equivalents. He's Emirati resident. He owns shares in an active UK and Hong Kong company. Both companies are involved in recruitment, but the aspect here is they're active commercial and trading. Clive is currently domiciled in the UK and has only lived in the Emirates for 6 or more years, so good enough. Clive, being my age, is a little concerned about IHT and succession planning. He plans to sell this business just before state pension age, 65, in 5 years' time, and he's not at all sure about the landscape in the UK. He may move away from the Emirates and perhaps live in Europe somewhere where there's some very, very attractive fiscal, residency and lifestyle regimes. Clive obtains tax advice through project manager by Sovereign, facilitated by Sovereign, and he's advised, as we have sort of come up with that suggestion, endorsed by tax advice, that the shares in the Hong Kong and thanks, Tiffany. The shares in the Hong Kong and UK companies are transferred and settled into an offshore trust. Bear in mind, Clive is genuinely non-resident. No plans of coming back just yet, and he opts for an Isle of Man trust. Could have Guernsey, one of our 2 of our centres of excellence for trust when it comes to having an association with the UK. The shares in both companies are settled and transferred into trust without capital gains tax and without stamp duty on the transfer. Clive utilises his HMRC's Business Property Relief Advanced Ruling Procedure, and HMRC confirm that, get onto the right slide, that the transfer into trust does not generate a lifetime inheritance tax charge of 20%. Next slide, Miguel, please. Yes, here we are. So simple situation. First of the two illustrations or many illustrations featuring two cases. Currently, Clive, UK domiciled Emirati resident, 100% shareholder of a UK company and 100% shareholder of a Hong Kong company. A lot of clients, a lot of British persons around the world might be the majority owner of active companies, both in the UK and overseas. So this has great wide applicability. Both companies are trading, commercial and active, and there is a balance sheet showing requisite details. Next slide, please. And this is the finished article. I'll look at the questions in a minute. Planning and structure to be deployed for Clive and family. Clive has created an Isle of Man trust and has perhaps settled £100 of initial property, because the trust cannot exist without property and an asset. £100 start with, perhaps. He's appointed sovereign trust as the overseas trustees, this time in the Isle of Man. That's like Guernsey, that's where we are licensed and regulated and have been providing these services 37 years, 4 decades. And Clive and children and family and loved ones are the beneficiaries. And the just below the top of the Christmas tree, you've got the UK commercial company, the Hong Kong active and commercial company, and the contribution into trust does not get caught for UK capital gains tax. Clive is non-resident, or SDLT. Should not be a lifetime inheritance tax charge of 20%. No UK income tax on dividends, provided that beneficiaries remain non-resident, and so dividends can go up and out if need be. No UK capital gains tax on the company or the trust, provided Clive remains non-resident. So when Clive decides to sell those assets, or those business asset, an active UK and or Hong Kong company, he should be non-resident of the UK, which if not, it defeats the object. And no inheritance tax on Clive's demise, but at that time, although no one's really in control of these sort of things, he should be in later life. Sorry, no inheritance tax on Clive's demise, but upon Clive selling one or both businesses, he should be excluded as a beneficiary. Not a difficult job for a trustee, but it is something that has to be explained carefully and compliantly. So that really reveals the case study and the illustrations. We'll come back to
so just a
questions.
Quick one on that.
Yes, go on,
in terms
Lawrence.
of if we've got UK Clives joining us today, is that this can be used. It would typically, if Clive were UK resident, he wouldn't have have a Hong Kong company. This was set up when assume it was set up when he became non-resident. Very, very typical. When people in Clive's position are UK resident, it will almost certainly only be a UK company that they use. That can go into a trust and does benefit from business property relief. But to get the relief from capital gains tax in this position, you'd want to have a UK trust there, and I think you'd want to probably have that anyway for various reasons. But I think just the point to get across today is that we can use this planning for UK residents, but it's not as good as this, but it is available.
And Lawrence, when we talk about April, we're talking about the next tax year, Javier. It's next tax year starting of 6th of April 25. So when we mean to do things before the next tax year, not before their budget, we're talking about April 25, but do it before 6th of April. Don't leave it to the last minute. Does the tax office confirm you are non-dom? No. Not really, no. But because you can't fish for an opinion from the tax office. Lawrence, quick technical answer, please, on that.
Yeah, I mean, they won't unless there's a significant amount of tax at stake when you're settling assets into a trust, which is going to be too much of a tax risk, so you wouldn't want to do it. But they do offer the BPR facility.
Yes, they do.
So that's very useful. If you're in Clive's position, you can go and apply to the revenue, and they will give you a ruling to say, yeah, that is outside of IHT, it's valid, binding for 6 months, and you can pop your shares into trust with the safe insurance that HMRC have given you a ruling. So very, very useful.
And also the more details, Steve, you've been responded to by Tiffany. You've been responded by Tiffany about how to get in contact with us if you've got a direct personal question. That's in the last slide. That's Keen Kene, sorry for mispronunciation. Can this Isle of Man structure be utilised for a non-resident person who owns several UK investment? Should we leave that to the last? Should we leave that to the end? Or
yeah, let's go through that at the end. Yeah, so we can move on now.
But we can answer it.
Yeah, we can. We'll answer everything.
Next slide, Miguel.
Yeah.
Yes, we're on it.
Yeah.
Lawrence, this is you.
Yeah. So thanks, Simon. Right, so we're shifting on now to looking at family investment companies, but we're still within the part where we're looking at expats here who have UK exposure to inheritance tax. So in this is not a case study. It just provides you with a template structure for a family investment company for a non-resident who, as I say, has exposure. So in this we're assuming here that the person who has the capital is UK domiciled, but a non-UK resident, and they contribute cash and they can't contribute cash. So it's just cash going in exchange for A and B shares, and in exchange for a loan note. So some shares and some loans. The shares are dividing into two classes, A shares, B shares. So step one is that the cash goes in and the donor has three classes of assets, some A shares, some B shares, and some loan notes. A shares carry only voting rights, B shares carry capital and income rights. So you do split up those rights. Step two, the donor gives away some B shares to his children and some of the and 30% of the A shares. So that's what happens at step two, and it's quite important that you follow those percentages. And the end result is that effectively the donor, the person who's put in the money, they hold most of the A shares, but they've given some away. As I say, a typical breakdown is 70% is held by the donor, 30% held by the children, but all of the non-voting shares, the B shares, are held by the children. So provided the donor survives for 7 years, then he's only, or she is only, taxed on the value of the A shares retained, provided they survive for 7 years. The main issue for non-residents is just gift with reservation of benefit, which we call GROB. That's fine as long as you take careful advice on this, which we can ensure that you do. That shouldn't be a problem. And then just ensure that the drafting of the articles is key. Now, this is pet dependent, this planning. So with pets under threat, you might want to consider this if you've got cash at the moment and you can set one of these up quickly. This is something that you want to be looking at, and certainly for ones of these that I'm looking at with clients at the moment, we're aiming to get the gifting of the A and B shares done before the 30th of October, because obviously that is a pet. So you want to be getting your pets done now. Exactly. So it may be that you don't have time to set one of these up before October, maybe that you do. And I should just note, with this type of emergency planning that you may want to undertake, you don't necessarily need bank accounts to be opened. It is possible to get assets in and move assets around through pieces of paper rather than actual physical movements of cash. It is easier when you're dealing with cash than other things. So it is still possible to do this if you're inclined to.
Thank you, Lawrence.
Yeah. So that's that. We're moving on to the UK one now, and over to you, Simon.
There are a couple of questions on real estate, but we'll leave that to the Q&A, Lawrence, because we're keeping to the content section of page 2 of the presentation. Now on to part 3. There is the thing I was going to ask when I was driving to the station this morning, getting in time for this. I was not able to listen to Rachel Reeves' interview with Nick Ferrari on LBC for those people that are coming in on attending in the UK. But there's a Labour Party conference today, starts once, doesn't it? Where they may announce sensationally what might happen, but I don't think they'll give too much away before the budget.
No.
But you'll be able to get LBC on you'll be able to listen to any LBC interview online, of course, which will be recorded. Nick Ferrari, good bloke that he is. Right, this is the applicability here is for persons that are UK resident, maybe not moving away from the UK just yet, may not want to move away from the UK. Those that are domiciled and non-UK domiciled, but very much UK resident and staying so at least for the short-term future, and they're going to be setting up a UK FIC because they're not planning on becoming non-resident in the immediate future, and they're contributing any amount of good capital into the UK company. It doesn't have to be 3 million. That's not necessarily a threshold. We'll take cases on their own merit, case by case, without obligation. So a contribution into the UK company in exchange for the head of family, as I like to call it, receiving the share classes. It's important that all share classes are allocated to her or him or both, as the case may be. And as it's a UK company, there may be a wish for the contributor of capital to be one of the board members, not the exclusive board member, or one of the board members. Careful on loans compared with a UK family investment, an offshore family investment company, due to the settlements legislation. But UK persons staying in the UK, domiciled or non-domiciled, contributing capital in exchange for receiving all of the share classes, being the director, having a little bit of flexibility, full financial freedom. And the donor holds, therefore, the A shares, which would be voting, the B shares, capital and income, possibly not voting. Careful on the loans, though, don't be too aggressive on that. The step 2 is the receiver of all share classes gifts B shares to children, perhaps 30% of his founder A shares. And you've got some provisions there if the person setting up this arrangement is non-UK domiciled, and he's got the gifting of cash for share subscriptions of dependents underage or of age, on the basis that our clients that are a bit younger than the classic Swiss private banking client survives entrepreneurial in scope, survives 7 years, potential exempt transfer, therefore no IHT should be suffered, and only IHT would be suffered on the value of A shares retained. Hopefully those shares go down in value and the other share class goes up in value. Carve out planning for gifts with reservation of benefits, careful on the annual tax on envelope dwellings. If real estate is held by the company, let's try and get it rented exclusively to third parties as opposed to enjoyed 1 day or more by the family, and avoid over complicated matters with especially loans due to the settlements legislation. Potential exempt transfers could be under threat, but currently are not. Watch the budget, and we'll keep you all tuned in with that. That's the case study for family investment companies.
And I think just one quick point on this, the relationship between the offshore and the onshore. What you might want to look at, for those of you who are going to fall within the FIG regime, is that you set up your FIC and you fall within the FIG regime, but potentially you're going to have future inheritance tax exposure because you're going to be a long-term resident, could become liable to inheritance tax on worldwide assets after 10 years of residency. Or indeed you're currently UK dom but have been non-resident for more than 10 years, so you should then be eligible for FIG, is to look to set up an overseas FIC when you're non-UK resident. So the model we've just been looking at, that I was going through, so Isle of Man typically, or Guernsey, you then have income and gains not taxed in the FIC itself for the first 4 years, and then you can take dividends out of that without tax in the UK as well for the first 4 years. So really, really good. And then just before you come to the end of the 4th year, you then the overseas directors resign, and then you appoint UK-based, probably the individual, the client, if you like. They're appointed as UK directors, and then you bring the FIC onshore, and then it just files tax returns as a UK company and pays corporation tax. And it means you have then kind of got the best of both worlds, because you've benefited from the FIG, the overseas arrangement for the first 4 years, whereas if you had this for your first 4 years, you've wasted the FIG.
Okay, absolutely. Lawrence, we're over halfway now, but we've still got a bit of time to catch up, and we've had loads of questions which we tried to answer, just in case people have had to drop off. Next slide, Miguel, please.
So we're going to continue with the questions later on.
Absolutely. So qualifying non-UK pension schemes, I'll just canter through this, then hand over to Lawrence for the last case study. Qualifying non-UK pension schemes, not to be confused with QROPs. And this was legislated positively by the then Parliament in 2010, ladies and gentlemen. QNUP's favourite jurisdictions, Guernsey, Isle of Man and Malta. And Guernsey is our favourite since it offers greater investment flexibility, permission to purchase residential property, full permission to purchase all types of residential and commercial property, and I would suggest that the property be rented so it generates an income for the actual pension scheme, because it is, at the end of the day, a pension scheme. Maltese QNUPs benefit from being established in an EU member state. They're not about to leave, are they? Full members of the EU, and got tons of benefits from being in the EU. So you've got EU pension protection there. Minimum retirement age 50 in Malta, minimum retirement age like the UK in Guernsey 55, and pensions must be crystallised before the age of 75. Usually QNUPs, from our clients' perspective, our private clients that are looking a little bit towards retirement, tend to be established before state pension age, and coming up to regular pension age of 55, if you can call it that. The QNUPs fund remaining on death of the member is usually inheritance tax exempt. So those that are pension friendly, useful IHT natural planning, and a contribution to QNUPs are not tested against the annual allowance. That's why a lot of clients tend to have their QNUPs at the side of their regular pension schemes, especially as a QNUPs you can have member loans, purchase of residential buy-to-let property, and a wide diversified investments, which perhaps your SIP trustee would not perhaps tolerate, certainly on the property side. QNUPs are exempt from the relevant property charges, and a UK property portfolio held by a QNUPs directly. So that's the pension trustee owning the buy-to-let portfolio, whether it's commercial, but quite often residential, or they own a property company UK offshore, should not be exposed to capital gains tax as it stands at the moment. But directly owning a QNUPs with property below it directly has some quite compelling capital gains tax advantages. And we've got counsel underpinning that what we're offering today, QNUPs and all of the suggestions and solutions case studies, are not DOTAS, Department Disclosure of Tax Avoidance Schemes, not scheming at all, in compliance with GAR, Global Anti-Avoidance Regulations, TAR, Targeted Anti-Avoidance Abuse, or Targeted Anti-Avoidance Regulations. We do not peddle tax schemes, and that's really the introduction to QNUPs. Quick question, Lawrence: will QNUPs be I think that means exempt, ED, from tax-free lump sum allowance abolition if they apply to SIPs? Where you're asking us to look into the future there. So the lump sum tax-free allowance is permitted, but Lawrence, technical point.
Yeah. So QNEPs at the moment, if they qualify as an overseas pension scheme, which has a special definition, they do attract the exemption for lump sums. So you can, as a standalone allowance at the moment, receive up to 268,000 from a QNEPs without paying income tax on that, or 25% of the fund value, whichever is lower. So if you've got the million in a QNEPs, you could take up to 250,000, 25% out without tax. That exemption was preserved when they made all these changes to lump sums earlier this year in Finance Act that came in February. They specifically preserved that exemption. It remains to be seen whether they're going to preserve it going forward. There's been some disappointing publicity on QNEPs and quite unhelpful publicity and not accurate, I would say. But let's hope that the government takes sound advice and doesn't kind of knee-jerk into doing something silly with QNEPs, because you know it's very, you need detailed advice on them, and they're not the be all and end all with inheritance tax planning. It's very much a cost benefit analysis that you need to undertake with them, and obviously you have to have a pension need too. So it's not as if everyone is using them who has inheritance tax exposure. It's far from the case. So I think if we can move on to the case study,
we've still got to get to part 4, Lawrence. So we've had 10 minutes of questions already. So part 4. The case study, actually.
So Helen is 45 and she's UK resident and domiciled. Typical case. She's within the 45% income tax bracket, so her gross income exceeds 125,000 each year. She has a portfolio of listed and unlisted investments. Small shareholdings in non-UK companies are the unlisted investments, totaling £1 million. Unlisted investments are pregnant with capital gains of circa £100,000 of gains, and the listed shares have small gains. So she has a small pension of 150,000, and she wants to make an additional provision for her retirement. So she's 45. This is definitely 150,000 is insufficient for future planning, retirement planning. She's also concerned about her capital gains tax exposure if the rates of CGT increase. She therefore decides to sell the listed investments now and pays the tax of, so the listed stand at £100,000 of pregnant gains. So they're easy to sell. We can do that in a day. 20% tax. So she pays £20,000, and then she's got cash to pop into the QNEPs. And she also then transfers the listed investments, the unlisted investments into the QNEPs, and she pays the small amount of capital gains tax on that too. So the QNEPs then sets up an investment account through which the cash is invested. So it holds two assets: the overseas unlisted investments that she's transferred in and paid the CGT on, and then she's sold the listed investments, and then she's popped the cash in, and we're looking at about £1 million that Helen has put in to this QNEPs, which represents about 20% of her estate in this example. Perfectly reasonable tax planning, I would say. So if we then move on to the next slide, it just illustrates how this looks. So we're using a Guernsey QNEPs here. So Sovereign Trust Guernsey. Helen is the settler, is the member. She's popped cash and unlisted shares in, as I've said. Helen is the beneficiary. She's the member. That gives her the right to benefit during her lifetime. Her children have the right to benefit on her death. It doesn't make sense to put your spouse in as a beneficiary of a QNEPs. Best to always have children rather than spouse. Overseas listed shares and the cash, as I've said. Transfer of the unlisted shares in crystallises the CGT at the rate of 20%. Helen obviously has the cash to pay that because she's sold her listed investments for cash. So she's going to use those proceeds to pay that tax and this tax, which is triggered by the transfer in. If we were investing in UK investments through this QNEPs, you may well want to have an overseas company in place. The reason being is that if you hold the QNEPs hold the UK investments directly, and one of the beneficiaries is UK resident, you get UK income tax at the top of the 45% rate if it's non-dividend income, or 39% rate generally if it's dividend income. So if you hold those through a company, most types of UK income, certainly passive income, isn't then taxed. So there's the benefit in doing that through a company, an overseas company. Assume here, though, that we're not holding any UK assets directly within the QNUPs. It's all overseas, so we don't need that additional layer. Potential for the gains that are made by the QNUPs. They won't be taxed at the QNUPs level, and they shouldn't be taxed on Helen in these circumstances. But do note that requires tailored advice and a case-by-case analysis, because there's a lot of anti-avoidance legislation that you need to run through there. Don't just assume that QNUPs, the income and gains accruing to a QNUPs, are not taxed on the member, Helen, if they're UK resident. If she were non-resident, then it's a lot more straightforward. Being UK resident, we have wide-ranging anti-avoidance legislation. Not going into that today, but just that's flagged for as an FYI that just should not be assumed. Clearer cut, though, is there's the exemption from the relevant property regime, and if it's structured correctly, no inheritance tax on Helen's death. So I think that's a good solution, a vanilla solution for people to consider in the circumstances that Simon identified earlier.
Very good.
So
we've got to get to section 4. We've had tons of questions, Lawrence, but we'll start with the next slide, Miguel, the penultimate to part 4. And the applicability here, ladies and gentlemen, are to persons that are generally non-domiciled and non-UK resident, or non-doms that are only here for a couple of years and will escape the 4-year new the new FIG regime. But there's plenty of persons that are non-domiciled, British people that are no longer coming back and have acquired a domicile of overseas choice. They're non-resident. So one question that I received last week was, is there a future for trusts? Yes, there is. Overseas excluded property trusts, and this is what they're used for. The settlor is non-domiciled of the UK, appoints the trustee. It's an overseas trustee, Guernsey, Isle of Man, but we offer trustee services in 9 jurisdictions, ladies and gentlemen. They wish to appoint themselves and their family, spouse, children, or the loved ones. Doesn't have to follow the will as beneficiaries. The initial settlement is £100 because you can't have a trust without a trust fund. And they're going to appoint a protector. Could be a member of family, could be an advisor, and someone that is not going to be a settlor, trustee, or beneficiary, because they understand the family dynamics and especially how one should react and how they can work with the trustees come a negative event happening, like an untimely demise. The trust fund, again, has to be non-UK specific. Cash at bank, overseas cash at bank, overseas investment management. The trust can own non-UK companies, trading companies, or an offshore family investment company, for example, non-UK real estate, but non-UK real estate. And I already mentioned trading and non-trading companies. So applicability for non-doms and non-UK residents and expatriates that are no longer UK domiciled. And I'll
so just to be clear on that they do have to be non-dom to set. Always got to be non-dom.
Exactly.
Just to be clear.
Okay.
And these do come now with a bit of a health warning that we discussed earlier, but at the same time, if you are in a position to utilize them at the moment, particularly if you're a non-resident non-dom, so typical expat who's acquired a foreign domicile of choice, there are a lot of clients that are using this at the moment because of the uncertainty of what Labour might introduce.
Lawrence, Jonathan from Malta, our friend from Malta. Good morning, Jonathan.
Hi, Jonathan.
Good to hear you, or good to see you. He said, can the beneficiaries be, as long as the settlor is non-domiciled and non-resident, the beneficiaries can actually be UK resident, but Lawrence, can't they?
So all the beneficiaries can be UK resident and UK dom. The key is that the settlor has to be non-dom and not deemed dom, and overseas assets have to go in. Doesn't matter about the beneficiaries.
Got to ask you us both to answer this one. Mark has come in at There's going to be 5 more minutes, ladies and gentlemen, because it's about escaping the UK, if you like, positively. Labour has recently said they recently, it's a touchy point, have recently said they recognise that offshore trusts will have already been established by UK resident non-doms and structure reflect the IHT rules. So they're considering how the new rules can be introduced in a manner that allows appropriate adjustment. Any ideas what they mean by appropriate adjustments?
Well, yeah, I mean, that's anyone's guess, isn't it? And they've backtracked slightly from what they said previously. But I mean, it's interesting on EPTs, and we are very short for time, but Labour are claiming they're loopholes. The irony is that they're actually introduced by the Labour government in 1975 when they introduced capital transfer taxes. So they're clearly not a loophole. And you could have EPTs where the settlers died many years ago, so clearly that's going to have to be grandfathered. I think that you are going to struggle though where you've had ones that have been established many years ago, and then the settler becomes resident for 10 years. It would seem grossly unfair in that situation. I mean, I did mean to write into the government on this. I haven't had the time, but on this point, which is, well, how are the trustees meant to police the settlers' residents? Because settlers are not the clients of the trustee. The trustee owe their duties to beneficiaries. So they were quite common, actually, that the settler settles the trust, and we then, our duty is owed to the beneficiaries, not to the settler if he's not a beneficiary. So we're not having to police where the settler's resident. But if Labour are introducing this new rule that trustees are going to be exposed to relevant property charges, so 10-year charges, where the settler's been UK resident for more than 10 years, how are we actually meant to know what our liability is in those situations where we haven't been following the settlers' residents? And I think that is a point that they're going to have to look at.
Although, Lawrence, because, our compliance with settled laws, because we speak, meet and deal with them regularly, is a little easier than perhaps other trustees. But yes, it is a challenging outlook.
Yeah,
it's a challenge. Now, Susan, beneficiaries have to be direct family? No, they don't. It doesn't have to follow your last testament if you have one. 60% of the UK population do not. So I'd encourage wills be made, updating of wills, but no, they don't have to follow spouse, children, mum, dad, sister, brother. It's up to you. That's the beauty about using a trust. Now, there's 5 more minutes, ladies and gentlemen. We've got to get to pay. We've got to get to part 4. Miguel, slide down.
I mean, I think what we can do for the residents, this test, we'll just leave it there as a reference slide.
That's a reference, but do you want to quickly canter? Quickly, a quick 30 seconds, Lawrence, on that one? Because it's a vital slide.
So this is how you become non-UK resident. There are 3 tests: the automatic overseas residence test, the automatic UK tests, the sufficient ties test. The best way of becoming non-resident is to fall within one of the automatic overseas residence tests. For people who are leaving, the 2 relevant tests are the full-time work overseas test and the 15-day test. So you either leave the UK, work full-time overseas. You can spend up to 90 days in the UK under that test, or the other one, which is you're not working full-time overseas. You can spend up to 15 days in the UK in the tax year, and you'll be automatically non-resident. They're the 2 most powerful tests.
Exactly.
If you can't do that, then you've got to always avoid all of the automatic UK tests. The 2 ones you really need to watch there are the full-time work in the UK and the UK home test. The UK home test poses particular problems. Then if you've managed to circumvent those tests, then you've got to fall outside of the sufficient ties test. For most of our clients leaving, they always have the 90-day tie because that looks at the 2 previous tax years. Most of the time they keep the accommodation, have 2 ties, assuming they don't have the family tie and the work tie, the country tie. They're normally easier to avoid. You can spend up to 90 days in the UK for the first 2 in each of the first 2 tax years without being resident.
And Nigel, question: what if I retire overseas? A lot of people like Nigel are not engaged in 35 hours a week, a minimum contracting or employed for 35 or more years, 35 more hours. So I'm trying to rush. So you look at the sufficient ties test, and anyone wanting to have a little more on this, we've got a 3-page guide, practical guide, and even when I read it twice, I can follow it follow it like a children's
Yeah, just
reading book.
on that, you've got to avoid if you can't fall within the automatic overseas tests, you've then got to ensure you avoid all of those automatic UK tests, and they are
Yes.
quite tricky. Then, assuming you do that, then you go down to the sufficient ties test.
Yeah.
That's the third part of the exercise.
Exactly. And for Nigel, it's the
if you
sufficient ties
yeah,
test.
yeah. Okay.
And thanks, Lawrence. Sorry to rush you. It's a key key ingredient to comply. Be a good leaver. More difficult to leave than it is to arrive. But Nigel, follow the sufficient ties test, and we got a useful 2 to 3 page memorandum on this, which we can share with anyone that's interested. So next slide, Miguel, please. And we're on to the ship sailing through the sunset. The most popular nations to move to, and being in full compliance with the UK statutory residence test on departure and leaving that. And Susan, if you share me your email, I'll send those statutory residence test notes. And here we've got the most popular EU domiciles to move to. Yes, the European Union are now sponsoring tax competition. And as there is still over 250 of you, we'll just spend 5 minutes with this because we've almost answered your questions. So the EU are sponsoring tax competition in terms of they are trying to attract entrepreneurs, mobile executives, younger retirees, remote workers, and Cyprus. Cyprus under English law has a classic old-fashioned non-dom style of legislation. They're not about to abolish that because it brings a lot of wealth into the country. Ironically, Greece and Italy are civil law, Roman law nations, and they've adopted what the UK is losing, and they have a very attractive non-dom lump sum tax regime. Malta has always had one. Portugal remains immensely popular with passive residency regimes, and Ireland has always had a non-dom, no time frame on that one in terms of the amount of years in which you can enjoy that status. So looking at the residency grid, we've got the nations down the left-hand page. We've got the tax regime. Most of those are non-dom with exception to Portugal, which is onshore, and they've just lost their non-habitual residency regime. Finance centre status, well, these are all onshore, despite being low and no tax. Thank you for your emails. Tax implications are very generous compared to what the UK is now suffering for both UK DOMs and non-UK DOMs. And the basic requirements in white and yellow there, ladies and gentlemen. You could read too much information on the internet about this, but we've condensed it down to a nice little grid. The popular ones at the moment are Cyprus, because some Portuguese are moving out to Cyprus because there's no dividend tax and there's 5% tax on pensions. Greece and Italy come next with the 7% tax on pension income and regular income. And Malta is also popular. Next slide, please, Miguel. Yes, thank you, Susan. Gibraltar. Well, I've gone into alphabetical order now. The first slide was EU, because that's not so far away. And then you've got these in alphabetical order. Have to say that Bahrain, Dubai, and Hong Kong, entrepreneurs tend to go there for investment, business, trading, and work purposes. But Hong Kong, like Singapore, has a territorial tax status, very friendly. Dubai has no income tax, but it has corporation tax at 9%. Big deal, 9% on corporation tax, 5% on a VAT. Bahrain has zero taxation on businesses, companies, and income. Well, the income tax rate personal income tax rate for Bahrain, Dubai, and Bahamas is like Monaco, no taxation there. Gibraltar is a low tax jurisdiction, fixed minimum tax liability of 37,000, 2.5 hours flight to Gibraltar. English law. I used to live there. I was the MD of our headquarters quite some years ago, and I've already mentioned Hong Kong. Next slide, please, Miguel. This is the last one. And in alphabetical order, we've got Mauritius, Monaco, Principality of Andorra, for those that like the French lifestyle but want to have the security of low tax. Andorra is 10% on income tax, 10% on corporation tax. But Mauritius is attractive because they've got regimes for professionals, self-employed. Buying a property for $375,000 gets you permanent residency. That's a property purchase program, and you've got a retirement program as well. Minimum income, no taxation on non-remitted income, and it's a very tax friendly from the Mauritius. Cannot be taken for granted. It's a lovely place to live, and it's very, very popular. Monaco, still zero tax, but it's the tax to a point is the cost of living. It's a high cost of living compared to Andorra and Mauritius. I mentioned Andorra. Singapore is more for business entrepreneurs or part-time entrepreneurs going into retirement, or remote workers. It's a source-based taxation. And Switzerland, if you're about to sell your business, extremely good. Move out of the UK before the tax year, settle in Switzerland for a year or two, take a capital gains, no capital gains tax, and you're taxed on a expenditure basis, not on your income or capital gains. It's a multiple expenditure. And then if you decide to stay in Switzerland, you're welcome. But if you want to move to an EU country, you've got Italy, Greece, and Cyprus, and a lot on your doorstep. So that this presentation, Gerald, will be sent to you, including the residency grid. The residency test notes will be sent to you all separately for those that have just cantered into that. There's still 250 registered. We will take a couple of questions. Lawrence, any closing out comments? Yes, no. Italy will increase their haven't yet, will increase their lump sum fiscal fiscal liability for the non-DOMs to 100 to 200 because they've been so successful in that program. Greece may follow, but not sure just yet. And again, Lawrence, how does in a quick question here? The questions are going. Questions are non-stop.
I just wanted just one comment before we move on to the questions, which I think is a key point to anyone considering leaving the UK. So becoming non-resident is the temporary non-resident rules.
Yes.
Jed, you have to be non-UK resident for more than 5 tax years. It used to just be 5 tax years. It now has to be more than 5 tax years. Generally speaking, that means 6 complete and consecutive tax years of non-residence, or in other cases, 5 tax years plus a split year on either side, either when you're leaving and or coming back. But it's better to do six tax years or more. If you don't do that, then any capital gains that have been made during your period of non-residence will be taxed by the UK or when you go back, when you become resident. And a lot of income is now subject to those rules as well. The main one that causes issues is dividend income of shares that you owned before you went. So please bear that in mind for anyone who's planning to do this. Temporary non-resident rules still don't apply for employment income though. So if you're going overseas and the only profit is going to be employment income, no gains and no other types of income, you still only technically need to be non-resident for 1 tax year, but we always advise minimum of 2.
Okay. And Lawrence, the presentation, a lot of points here. Thank you, ladies and gentlemen. Still hundreds of you in the room are going to get the presentation plus the statute residence test and double taxation treaties. Lawrence, I found a question. It's so many now, and I can't find the question, but it's about do double taxation treaties apply when I'm leaving the UK and perhaps going to reside in another country?
Well, I don't think a tax treaty would help you in your quest to become non-UK resident in relation to the exit charge, because remember that the exit charge is going to apply before you become non-UK resident. Now, possibly if you're at the moment you are resident under the SRT, but you're non-resident under a tax treaty, then potentially you could be sheltered from this exit charge in that situation. But to be honest, Most clients aren't in that situation. Most
Yeah.
clients have either escaped and are non-resident under the SRT at the moment. This charge isn't going to be retrospective. Some of my clients have been asking, well, I became non-resident. I was non-res from the 6th of April 2024.
Sure.
Will this apply to me? Well, really no, because that would just be retrospective legislation. We don't expect it to apply to people unless they're becoming non-resident from the 6th of April 2025
Correct.
onwards.
And the question, Lawrence, from Brian, thank you, Brian. How does dual tax treaties impact residency? I think you've just answered that.
Yeah.
And there is some thanks, and yes, I covered Gibraltar there, Susan, and we've got some additional notes on Gibraltar should you want them. There's 4 residency programs, and we've got a little presentation on that. As I once lived there, it's a little easier for me to give some commentary on that. There is I have clients that this is David. I have clients that have crystallized their pensions and completed a benefit election form. Sounds like a pension expert, but haven't taken their PCLS yet, their lump sum tax-free amount. If Labour reduces this, would the new rule apply in the 30th of October or perhaps the 6th of April? It's a very good question. We can only speculate with some authority.
On the lump sum stuff, they might be more generous there than say with the rate increases on capital gains tax. The reason being is that you can only take your lump sum if you've reached minimum retirement age, which is currently 55. Most people like to take their lump sum. I know there are investment considerations and everything, but a lot of members like to take their lump sum as soon as they can. So really, if you think about it, introducing it on the 30th of October compared to the 6th of April, you've really only got those people who are 55 or over who haven't yet taken their lump sum, who could take it within that window. And so they may think on that, well, we'll be repentant.
I agree with that.
We won't introduce it until the 6th of April 2025. But all of this is kind of crystal ball gazing. The advice, general recommendation, is to take the lump sum now if you can.
Yeah. Okay. And Mike, can you confirm the temporary don't like the word temporary, non-residency time period again? 5 full tax years. It is 5 complete and full UK fiscal years of non-residence, Lawrence, to benefit in the entirety for dividend and capital gains tax planning, isn't it?
So it has to be more than 5 tax years. So you're looking at 5 tax years plus a split year, okay, or 6 or more consecutive tax years. It's with this planning, you're better off to plan to do 6 complete and consecutive tax years of non-resident. So for those of you, to give an example, for those of you who are considering leaving on the 6th of April 2025, the best approach is not to be resident again until the 5th of April 2031. And that's 6 complete and consecutive tax years. But
doesn't look too contrived then, does it?
No, but if some of you are considering leaving now and falling within split year, if you say qualify for split year, this part, the overseas part of this fiscal year would count as split year if you qualify, and then you'd only have to technically do 5 years plus your split year. So it would be 6th of April 2030. You could resume residence because it's 5 years plus a split year. But as I say, that split year is so complicated, the tests. You were better off in practice just doing 6 or more.
Doing complete. 6 full complete and fiscal years. And there's a question here from Michael. Very good question, Michael. Under the old-fashioned rules, which we currently still have, Michael, how long after leaving the UK are you classified as non-domiciled? I had one client that's been resident of Andorra. Not sure if he's on the channel this morning. He's been resident of Andorra for the best part of 20 years and left the UK. He's a little bit older than myself, but not a lot older. And he's been left the UK for 40 years. And it's quite clear, due to his connections with the UK being ever so modest. I think it kept down to his daughter, one of his daughters living there, but that's about it. And he's hardly living there, and he's hardly going on holiday there. But I would say if you're severed your ties and you formed a permanent intention to reside overseas in the new country, Lawrence, it's about 7 years, isn't it?
Well, I think there's two parts to this question. It appeared to be that the question was concerned with the deemed domicile rules rather
Yes.
than domicile under general laws. So we maybe deal with the deemed domicile position. Remember, deemed domicile only applies if you're non-dom under general law. So it has no application to those of us who are still UK domiciled.
Yeah.
It only applies to people who are foreign dom under general law. So once they have been UK resident for 15 or more out of the previous 20 years, they become deemed domiciled for income tax, capital gains tax, and inheritance tax. That's the position. But that's assuming that they don't intend to remain in the UK permanently, so haven't acquired a dom of choice in the UK. They've still got a home elsewhere. They still want to leave the UK and move somewhere else. So that's
if Michael is he's got a very with respect, Michael, popular common surname, he's probably UK born and domiciled. And Miguel, last slide, please. If he's, let's say, is a person like you and I, but definitely like me, domiciled and resident, to shake his domicile of origin, what are we talking about, Lawrence? And I'll take more questions to the point as we go under 200 delegates. We've got a couple of minutes left.
Yeah, so you want to move to a new country, establish your home there. The key criteria really: family there, business ties, wealth, moving your wealth with you there, and then ancillary factors such as membership of clubs, associations, social ties, etc. So that's one aspect, is establishing strong ties with your new country. The other is severing UK ties, which you mentioned, Simon. So the key one is, if you've got property that's available to use and you used it as a home, you either want to be selling it or renting it out. You don't necessarily have to get rid of it completely, although it's always favoured, but renting it would be better. And then just relinquishing your other ties, ancillary ties with the UK, limiting your number of days spent in the UK. You would want to be doing probably below 50 or 60 in your first few years, just to show a clear break from the UK. And then in terms of how many years you need to establish residence in the new country, there's an old case where someone left for Australia. I mean, this is probably 100 years ago. And the courts found that they established domicile straight away in Australia. I mean, the cases like that don't really find them now, where you get on a boat and you're never going to come back. But still, it still is there as authority, and we do look at that in certain cases. I think it is possible technically to establish a domicile in a place immediately if you've established sufficient ties there over time. The rule is that once you have, but in most cases you're looking at, I would say, 3 to 5 years as a minimum period of residence. And then once you've done that, you remain deemed domiciled for 3 tax years from when you acquire the foreign domicile, the foreign domicile of choice. So if you say left for Spain now, a UK dom, leaves for Spain on the 6th of April 2025, let's just say they become domiciled in Spain by the 6th of April 2028, they would remain deemed domiciled for 3 years after that, so until the 5th of April 2031. Now, of course, all of this might not be relevant going forward because of the threat to domicile as the criterion, but that's the law as it stands at the moment. Oh, I've lost it. I can't hear you now, Simon.
Sorry about that. Yeah. This is a great question from Nigel. Might be the same Nigel. How to prove minimum 35 hours a week work, that's working contract, the statute residence test. Can I work for my own BVI company? You're not alone on this, Nigel. A lot of clients have set up their SMEs or micro companies. They're the director, they're the shareholder, they're actively engaged in commercial trade. Can you work for your own company, Lawrence? Can you have a contract with your company as well as being a director and shareholder? You can demonstrate that you're commercially working for those hours, the burden of proof on the taxpayer. What's your answer to that? Briefly, please.
Yes, so you can, yes, in principle. The evidential burden is higher, though, in those cases.
Yes, of course.
As you've said, the minimum hours that you have to work overseas is 35 hours. The cases I've dealt with on this are often more complicated, though, because the client we refer to them as that, the taxpayer. They want to often, if you fall within this test, it allows you to return to the UK for up to 90 days. The question then becomes, well, you can't work in the UK for any more than 30 days if you're returning. So it's quite a generous employer who, if you well, hang on a minute, you've come back for 60 days, but you're only allowed to work for 30. So that means you've got 60 days where you're in the UK and you're not meant to be working. I always find that that's quite a trap that I think they purposely set with this test. So what you need to do, I would recommend, is under the contract, it's not 35 hours, it's a lot higher when you're overseas. And then the way the reference period works allows for you to then go up to 90 days in the UK. But I would always say don't go up to 90 because you're kind of putting yourself on the back foot under this 35-hour work test. And then the other thing that you need to watch is to just make sure that the contract provides for annual leave for under the statutory amounts, and then perhaps a bit more if your employer that you own is a bit more generous. But then you want to be making clear that when some of the time in the UK is not holiday, it's unpaid annual leave. But yeah, I mean, you can do it in principle, but you've got to be very careful on both the contract and keeping all of the information that HMRC look for. So they want timesheets and all the record. Diary is another thing that they ask for. So if it is your own company, then obviously if it's sovereign managed, we can provide these services for you. It's obviously going to increase the time charges for the entity slightly or a bit, but it is vital that you keep all of that information in your Bible, really, and you just have it to hand if HMRC inquire into your full claim to be working full-time work overseas. And if you are still in the need of filing a tax return in the UK because you've got UK income, it is something that you have to tick the box on your return to tell them that you're non-resident because you're working full-time overseas. And yes, it is an area that they like to look into.
Okay, Lawrence, thank you for your compliments, ladies and gentlemen. Minimum, good question from Len. All questions are good because it keeps us on our toes. What's the minimum value of an estate which would benefit from input and advice from Sovereign? We're not asset managers, we're not IFAs, we're not wealth managers of a Swiss bank. Our starting level, we don't really have one, but I would, Len, if your estate is greater than the nil rate band for inheritance tax, 325,000 or combined 650,000, we can at least open the door of a conversation. So hopefully that will answer that one. There's a Keen again. Can an Isle of Man trust structure or offshore structure, let's start, Lawrence, you be utilised for a non-resident who owns several UK investment properties? Would a QNUPs be more economic viable? Okay, we've got
are they domiciled in the
I would say not, because he's got, with respect to Keen, I'm going to be very bold by saying you might have an African name. Doesn't mean not, I can't second guess your nationality and domicile, but there's a few UK property questions. He's asking about a QNUPs. Obviously, pre-owned assets are much more difficult to deal with than property assets you're going to buy next week. But briefly,
so
Lawrence?
What is the asset that they hold in a UK property portfolio wrapped through an overseas company? And it is residential. Is it
residential UK investment properties?
On this point, so it was something we were going to consider putting in the slides, but obviously there was a lot to go through as it was today. So if you've got, let's just say, an Isle of Man company, it's residential property in it, then that's a chargeable asset for IHT now since 2017, CGT since 2019. So if you pop those shares into trust, that's 20% tax to HMRC over and above 325,000. So that's an absolute no-no for anyone in the world. Everyone is subject to that tax. That's something you can't do anymore. If you you can obviously set up trusts with cash, and then the trust can invest in residential property up through a company. Normally that would be okay. If it's investment, then through a company is typically what you'd be used, because the asset that you're settling is still excluded property in the form of cash. I think one thing that's still missed, though, where you can use trusts, and it is an area that you might want to consider for anyone who's still remaining and has this, or has clients that they know that have it, is typically an Isle of Man company which owns commercial property in the UK, only commercial property, that can still be settled into trust, and that is still excluded property trust. Can go in. The shares are now chargeable to capital gains tax, but you get a rebasing to 5th of April 2019.
Yeah.
And the way the market has gone since then, it's tended to have gone down, not gone up. So you'll probably find your shares are worth less now in such companies than in 2019, which in many cases would allow you to settle those shares still into a trust. And that preempts the extension of inheritance tax to companies which own commercial property. At the moment, it's limited to overseas companies that own UK residential property, not UK commercial property. If you look at what they've done to capital gains tax, it started off as only applying to UK resi property. They've extended it to commercial property in all forms. So what's the bet that they're going to do the same for inheritance tax? And what you could do to preempt that would be some trust planning before they do it.
Right, Lawrence, we've now gone below the threshold. We've kept hundreds of people on the line. We're going to promise to answer each one of your questions. Amy, thank you, from Hong Kong, I think, Amy. Thank you for your questions. And Lawrence and I are familiar with Hong Kong. Lawrence lives in Singapore, travels out to Hong Kong a lot. I'm meeting Lawrence in Dubai tomorrow for a global residency forum, and those that want to can receive the slides for that as well. We will get back to each and every one of you with the statute residence test for those that want it, answering questions, because we've gone way over time, but we had lots and lots of questions, and the presentation will be obviously sent to you with the notes, and we'll address the questions. I'm with Lawrence tomorrow, so we'll be able to do the questions together. He can answer the difficult ones, I'll answer the easy ones. Thank you for your undivided attention. A super turnout, 300 plus. Thank you for your time. Thank you for your supporting comments. We'll come back with live attendance seminars for those that are in the UK, and future webinars post-budget, pre-financial year, start 6th of April next year. Thank you again, Lawrence and myself, for your attendance. And see you all soon again. Thank you very much.
Thanks, Simon. Okay, thank you.
Bye-bye.
Bye.